right, I mentioned that the markets in the U.S. at all-time highs. A lot of this came after we got data in the U.S. Consumer prices unexpectedly growing at a slower pace month over month. You can torture the data in different ways, but other metrics were essentially in line. This comes at the same time that we got retail sales slipping a lot more than expected. So generally, looks like inflation is a little bit more subdued. The consumer seems to be slowing down, and maybe that's a leading indicator of where inflation is going to go. About a month ago, our next guest said there was a risk of a rate hike, just a small risk, but there was a risk. So let's find out what he thinks now. David Doyle, Managing Director and Head of Economics at Macquarie Group, joins us now. Thanks for joining me.
Happy to be here, Amber.
Well, you were just following the data, right? So it's like several months in a row where inflation was surprising to the upside. And that's when you started thinking, do I need to think about the possibility of a rate hike?
Yes, that's right. So I think to kick off the year, January, February, March, you had the core inflation data in particular appearing quite strong and surprising the consensus estimates on the upside. The most recent reading that we had today, though, was very much in line with what people expected, and I think shows at least, I would say, less heat than was what looked to be the case in the first quarter.
Before this number, you'd ruled out the probability of a rate cut this year at all, right? And you were only expecting them to show up in 2025. Did these numbers change your view?
No, the numbers, I think, are very much in line with our inflation forecast. We have it as being consistent with roughly a plus 0.25% gain in the core PCE price index. So that would suggest a slowing, but still at about a 3% or so annualized pace. I don't think that that's a slow enough pace that will allow the Fed to cut rates in the near term. But it's also, I think, enough where you're starting to make some progress towards that 2% target. So likely reduces any chance that there was previously of that hike occurring.
Retail sales slumping a lot more than expected. What does that mean to you?
Yeah, I mean, I try not to sort of overemphasize the details of the month-to-month data. I think part of what we had there was a give back in online sales. There was a big, large sale from Amazon towards the end of March that boosted the March data, and I suspect may have pulled forward sales from April. So what we try to look at is the underlying trends. They're still solid, but not spectacular, right? So I don't think there's anything overly concerning in the retail sales data, but certainly suggests that we're in for potentially a more subdued pace of goods consumption than what appeared to be the case last month.
Well, I mean, University of Michigan consumer sentiment plunge. And to your point, I don't know how much stock you put in that because it's one data point. Inflation expectations went up. Now retail sales coming in lower. Some retail exposed companies have been warning, like Starbucks and McDonald's. I mean, you can really stitch together a narrative of a softer consumer.
Yeah, I mean, you can if you, and I would argue if you want to cherry pick the data
okay,
points.
So tell me what's
right?
the other stuff
So when we
look
look at it, the health is really there in the labor market, right? You still see very solid jobs growth. You had very strong hours worked growth in March. Now, there was a bit of give back in April there, but overall the trend, is on the upswing. And then you have positive real wage growth, right? So real wages are positive, and when you have that plus solid jobs growth, it adds up to a pretty solid state for the consumer going forward.
This doesn't seem to be a market that really needs a rate cut right now anyway, right? I mean, we're talking about all-time highs, even as rate cut expectations have been pulling back.
Yeah, I mean, and that informs our view, right? Our baseline view that the Fed can wait until 2025 is that where's the urgency, right? When you have real GDP growth that's trending, around 3% or so right now, and when you have unemployment at 4% or below, there's no real urgency to have that cut. And especially if there are some lingering inflation concerns, we think their bias will be to wait a little bit longer than some others suspect will be the case.
Does a rally in the bond market then make sense? So we're seeing, yields, the U.S. 10-year at 4.3%?
I think what's happening in the markets today is that people had been fearful of that chance, albeit even if it was a slim chance, that the Fed might need to hike rates. And I think what today's data suggests is that even though maybe a rate cut isn't on the horizon in the near term, a hike is now probably very unlikely.
So that feels like a big shift for you in the last
I think what it is it's a relief that sort of downside scenario. I think the market is less concerned with when the Fed cuts, with and more so concerned with whether or not the next rate move will indeed be a cut rather than a hike.
How do you think about how it's going to play out in Canada?
In Canada, I think there's more scope for cuts to happen near term. The inflation data have been much more favorable. We think our base case is in July.
Okay.
But we get the April CPI next week. If that is very, very low, it could put a June cut on the table. I suspect that Governor Macklem will be inclined to wait a little bit longer and wait for that July meeting. But I think in Canada, the case is more clear cut, that a rate cut is likely to be the case near term.
Even with the job growth numbers that we saw?
Yeah, I mean, again, that was just 1 month, right? The trends in jobs and the trends in unemployment are still, I think favorable for a rate cut. I think you'd really need unemployment to start to fall back down again for the Bank of Canada to think, oh, maybe we don't need to cut near term. I do think when they cut in July that it will be a cautious one if they do proceed in July, and that the next cut won't happen for another couple of meetings. So it won't be every meeting or something like that. It will just be at a more measured pace when it does start.